Hey everybody, this is Danthika Borst with the first episode of Demystifying Lending, a 4-part series where we will make lending easy. Today I will be sitting down with Cheryl Nolan, someone I've known for a very long time, and we will be talking about pre-approval versus pre-qualification, which is better and why you should do it before you start your home search. Come on, let's go in and meet her. Thanks for joining us, Cheryl. So the words pre-qualification and pre-approval are words that we hear a lot in the home buying space. What is the difference between a pre-qualification and a pre-approval?
Well, when you get pre-qualified, you're basically giving me the information, income, assets, things like that over the phone or via an online application. And so basically I'm just using those numbers to see if the numbers work and the type of loan that you might be able to qualify for. To take it a step further, you want to get pre-approved. By getting pre-approved, you're going to send me documents like your pay stubs, your W-2s, your tax returns, your bank statements. And that way I can visually verify that those numbers are true, and that helps us get you pre-approved. And I can also take it one step further. If the numbers are a little bit tight according to the debt to income ratios, I can run it through an automated underwriting system which has all the guidelines working in the background to tell me if you're approved.
What is a debt to income ratio and why is that important in the pre-approval process?
Sure. Different programs have different numbers that we have to go by to give an approval. A conventional loan is a little bit lower on the debt to income, and what that means is they take your income and compare it to your debts. Your front end ratio is a ratio that is just your new housing debt. Your back end ratio is your new housing debt along with all of your other debts.
What does it mean when you ask somebody, what is your credit score?
Sure. So we pull the three different bureaus, Experian, TransUnion, and Equifax, and we use the middle score. And if there's two borrowers, we're going to use the middle score of the person that has the lower middle score. And the scores help determine what your interest rate is. A lot of times people ask me, what is the interest rate today? Well, that's like asking me, well, what's the weather today? Well, I don't know, where do you live?
Yeah, exactly.
So it does play a big factor. Sometimes people with lower credit scores, I may put them in an FHA loan because FHA loans are more forgiving, and they also have a higher back-end ratio, the debt-to-income ratio.
So would you recommend that you start doing this before we start looking at houses, or should we wait until we find a house? What do you think?
No, you should absolutely get pre-qualified, pre-approved before you start looking at houses, because you may find out that your credit score is much lower than you think it is. So you should absolutely talk to a lender first so you know how much home you qualify for based on your income and assets and things like that.
Thank you so much for tuning in to episode 1 of our 4-part series. This is just the beginning and we have a lot more to talk about. Make sure you tune in next time for part 2. I'm Danthika Borst, and don't forget to like, share, comment, and subscribe.